Right, time now to explore what's happening with the property market. Since interest rates started to rise, the topic's been all over the media and the subject, of course, of many conversations. So here to hopefully give us a bit of clarity, we're very happy to welcome Katy Warrick, who leads the Savills London Residential Research team. So thank you so much for joining us and welcome along to the show. And I think I'm right in thinking that you are the person to ask when it comes to the UK housing market.
That's right. Thanks for having me. So I work for Savills in the research team. I'm a director in the team focusing on the UK markets. I have a particular specialism in thinking about London residential market and even more of a specialism on the development market.
Okay.
I work out of the head office, but I have spent some time travelling around, working in different offices around the world. I spent some time in the Singapore office a few years ago, really trying to understand international demand for London property.
Wonderful. It's going to be great to get your expertise today. Okay, so current state of the market, are we looking positive? Is it volatile? Is there uncertainty?
There's a lot of uncertainty. It is still a little bit volatile, but it is eking into a slightly more positive territory. So the good news is that house prices at a UK level have erred into positive territory now. So we are seeing price growth, very minor levels of price growth, which is, of course, a positive sign, but we're not out of the woods yet. There are a number of different indicators that we look at incredibly closely. One of the key ones for a forward-looking indicator is something that we call the RACS balance of opinion. I might need to explain that for you.
Yes, please do.
It's a bunch of chartered surveyors are asked a number of questions as to what they think, the experts in their patch, what they think is happening to the level of new buyer inquiries and the level of new stock coming onto the market. So with those forward-looking views on whether stock is coming up or buyer inquiries are increasing, we can start to get a picture of what might happen to house prices. And at the moment, this sentiment, this survey is showing us that new buyer inquiries have erred into positive territory for the first time since April 2022. So that is a positive sign. But of course, we know that interest rates are a big part of the picture for the housing market. And the base rate, it hasn't started to come down just yet. And the mortgage markets, the mortgage rates are fluctuating a little bit.
Okay. So yes, let's speak a little bit then about prime markets, which I know is your specialist field, isn't it?
That's right. So Savills cover the prime markets incredibly closely, and they do move quite differently. They have different drivers and different buyer types to the more mainstream markets. And I would say the key difference is that, a prime purchase is more likely to be discretionary, whereas a mainstream purchase is more likely to be needs-based. And, people only have so much money that they can afford to spend on their property in the mainstream market. They're much more constrained by the higher cost of debt at the moment, whereas in the prime markets we know there's much higher levels of cash activity. And so the clear difference that we have different pressures facing these different groups of buyers. The prime markets have been a bit more resilient and have a little bit of a stronger outlook in the short term.
Okay, now interest rates, we all know they're so key, and of course there was that huge shock a while back. But things have settled down, or?
So the base rate hasn't moved. I think the interest rates are key, and the base rate has stuck at 5.25 now for a number of months. And I think once we start to see that come down, then it's a real sign that will be a turning point for the market, and that will start to feed into literally improving what people can afford for their mortgage, for their payment, their housing costs.
Yeah.
But also it's a sentiment point. No one likes to feel like they're making this big purchase at a time when house prices are falling, and what is the sign for the market that things are going to be turning. So I think that all eyes are on the economic data at the moment, and when we start to see inflation come down a bit more, we start to see a reduction in interest rates.
So there might be quite a lot of people sort of almost waiting in the wings, just waiting for that first nudge.
That's exactly it. So we're not economic forecasters, but we do think about the property market and the impact on the property market. So we use Oxford Economics as our economic forecasters of choice. They are currently forecasting that the base rate will start to come down very, very sort of, incrementally, small changes, but those changes will start to happen in June this year.
Okay.
So that could be the turning point, and then some gradual reduction through the course of the second half of this year.
Okay, now we've obviously just had a budget. How did that specific budget affect the prime markets?
So I'd say the big news from the budget was that there was no big news for property in the budget.
Seems to be the theme, yeah.
There were a few things that we were expecting that didn't happen, but out of the changes that were announced, there was some additional taxation for holiday lets, and there were some relief around multiple dwellings that's now been cut. So
gains tax,
and then there's capital gains tax as well, and that has been reduced from 28% down to 24% for higher tax for people in the higher tax bracket. There's one other change, which is the abolition of non-dom status, which of course may be familiar to some people who are thinking about this space, because of course that's been Labour's policy.
Sure.
So the Conservatives have jumped the gun and stolen that from them. So maybe some people were already thinking about this, but certainly that's come into effect a bit quicker than we would have expected.
Yeah. Okay. Let's have a little think then about the global markets. I know specifically you know quite a lot about places like Hong Kong and Dubai and so on.
So we have a world research team, luckily at Savills, and they track the number of world cities. They have an index of thinking about how these prime residential markets are performing. They've got 30 cities within this index, so it's a really good representation of prime property globally. And this index is in 2023, a year of massive uncertainty, high interest rates, a lot of geopolitical uncertainty. The prime markets did still perform they were relatively robust. We saw price growth of 2.2% on average across all of those cities that we track. But there are some outperformers within that, and Dubai in particular, astonishing growth of 17% in 1 year.
That doesn't surprise me. It's really sort of had a moment, has it? And you see it even reflected on things like Instagram, which are a little bit of an indicator of these things. These places get very popular.
It is a very popular place at the moment, and one of the changes, one of the drivers for that is of course like the in-migration that we're seeing from other areas of other wealthy areas like Russia, Ukraine. We're seeing some people move through there. That has been a driver for their local property market. On the other hand, areas like Hong Kong have seen prices fall. Even in the last 6 months, they've seen prices fall there by 4%. And the reason for that is, it's heavily linked to interest rates. It's also sort of linked to the China economy as well. So we do think that there's maybe a little bit more of a boost coming to the Hong Kong market, because their government has they've set some tax changes to basically try and address the fact that the property prices are falling, to try and to boost demand. They've provided some tax cuts on stamp duty for second homes.
Okay,
so we might see a bit of a boost there.
That's really interesting. And we've obviously got a year ahead with general elections on the horizon, not just here, all over the place. So as much as you can, crystal ball time, if we have a Labour government, which is looking very, very likely, how would that affect the top end of the housing market?
Yeah, this is something we think about quite a lot, and because of course previously under a Corbyn Labour government there was definitely some stronger proposals for wealth taxes, mansion tax. I don't know if you remember that. That was something that lots of property developers in prime London were sort of very scathing about. That didn't go down well at all. Obviously it didn't come into play, but that isn't on the cards now. That isn't what this current Labour government are proposing. What they are looking at is some removal of VAT VAT exemption on private schools. Yep. They're looking to introduce an additional tax on overseas buyers, but of course the Conservative government have also been introducing extra taxes for overseas buyers over the course of the last few years.
There's not that much in them, really, is there?
There's not that same polarisation that we have seen in the past. But the one thing that is a niggling thought for me is that the fact that maybe, in the latest budget, we've seen the abolition of non-dom status. That was really the Labour policy for focusing on the wealthy here. And will they bring in something else? We don't know yet. We don't have visibility of that. But there could be, couldn't there? It feels like there could be something else.
Spending, and now that's going to go towards the cost of the NI cut. So yes,
exactly.
Yeah, jigsaw pieces. It's like a puzzle, isn't it?
Absolutely.
Yeah. Okay, so let's have a little think then about the general outlook as much as we can. Can you at Savills do that? Do you look ahead in that way?
We do. That's one of the first question we're often asked by any of our clients is, what next? Great, you're tracking what's happened in the past, but what next? And we do some residential forecasts. We publish them every November. So I can talk a bit about what we published back in November, but also about what our latest thinking is about where that's heading. Because as I started off, the first couple of months of this year have been a bit more positive than we had expected. So what we published for the UK markets back in November, we thought that 2024 we would still continue to see price falls. We were expecting falls of -3% at a UK level, -4% for London, because the affordability levels compared to incomes, house price to income ratios, they're so stretched in London, much more so than the rest of the country. So we thought the price falls would be a little bit stronger in London. And in actual fact, we've started to return to price growth. So maybe we have already bottomed out. We're still cautious about calling that. Some of our competitors have reforecast and are now forecasting price growth for 2024. We're holding off, we're a little bit more cautious. But certainly over the longer term, once we start to return to a level of stronger economic growth, as we start to see a bit more positive sentiment comes a lot into certainly thinking about the outlook for the prime markets. We start to move past the general election and into this more positive world. In 2026, we start to see much stronger house price growth.
Yeah, I can also understand sort of the prudence, if you like, in being a little bit overcautious rather than over-optimistic for your clients.
It's a more comfortable position for me to be in, certainly, but it's nice to be able to talk about, there's an upside to these figures. And we're certainly tracking all of the economic indicators and the other forward-looking property indicators on a day-to-day basis across the research team.
Okay, now in terms of investors, let's talk a little bit about the reform bill. So this is going to impact rental markets, but can you tell us a little bit about what the bill is and what it means?
Yeah, sure. So the Renters Reform Bill, again, it's a topic that we're talking about a lot in the industry because it is quite a significant change. We don't often have regulation change in this market, and it will be, what it really means is it's going to be shifting the power away from landlords towards the tenants, and it's generally positive in all ways that it's looking to affect the market there. The abolition of Section 21 is the main thing that's being talked about, and that is where landlords will now need to, once this works its way through Parliament and comes into force in the next couple of months likely, landlords will need to have a valid reason to evict that tenant, whereas at the moment they don't need a reason, they can just do it. So some of those reasons, a reasonable reason to be able to evict your tenant would be if the landlord wants to move in themselves or they want to sell that asset and do something else with it.
Because if you break your contract, obviously you can be evicted, So this is to just prevent perhaps if a family have settled, they've moved to be near a school or something, and then literally 2 months later it's like you've got to go.
Exactly, it gives people a lot more security, and it's also sort of basically trying to target bad behaviour of rogue landlords. That is essentially what this new rule is trying to do. So it shouldn't really change the status quo too much, but we know that with any of these changes, some landlords are feeling a bit twitchy, and it's putting them off a little bit.
Okay. So there has been a lot for the rental market to contend with, because obviously we've talked about the interest rises and so on, but that really then goes on to impact the rental market, doesn't it?
Exactly. So where you see, we're seeing strong rental growth. We have seen really strong rental growth over the last couple of years, if, for example, in London during the pandemic, rents fell about 10%. But in that period afterwards, we saw this real burst of activity. And in the period since then, we've seen around 30% growth in rents in London, and that is really
a lot for people when wages haven't gone up in that way.
They haven't. Wages certainly haven't been tracking rental growth in this way. So they are very unsustainable. It's very unaffordable for renters to be able. And there's also a limited amount of rental stock. So it's not just about the rent that people can afford to pay. They can't find the right properties for them that they can afford.
Supply and demand pushes the price up. Yeah.
Exactly.
Yeah. Okay. So how are we looking then at the moment? Are things slowing down, or is it?
Yeah, so in fact, London has now this month seen the first monthly falls, according to Zoopla, of minus 0.1%. So very minor rental falls, but certainly going some way to demonstrating that a limit has been hit in terms of, that ceiling of affordability. So we have seen that turning point in the market.
It's for the best. I can't have my children living with me forever.
And that is one of the consequences, right? Because they just can't afford to.
Absolutely. Yeah. There's a lot of 30-year-olds still hanging around at home because, Right, let's talk a bit about investors then and challenges for them in terms of the rental market.
Yeah, of which there have been many. So, even going back to 2016 with the mortgage interest tax relief, so some tax changes that were, essentially just making the buy-to-let market less profitable for landlords. So, they're having to pay more tax. They've benefited potentially from the rental growth that we're seeing at the moment, but actually the forecast for rental growth going forward isn't as strong as what we've seen over the last couple of years. So there's a potentially less positive situation for them thinking about the next couple of years. There's also the tax changes. There's been additional sort of tax. The tax situation that makes it just a bit less favourable for them, as well as all of the regulation. So with the Renters Reform Bill and the things that we've just mentioned, it's just a number of these different changes just makes it a very difficult environment to sort of enter for any new investors coming in, but also for those looking to potentially rationalise their portfolios. The other thing that we haven't talked about yet is energy, another form of regulation that was planning on being introduced, and there was a sudden U-turn from Rishi Sunak at the end of last year, was around energy efficiency of residential rental properties. So we have this legislation for the commercial sector. It was due to be implemented, I think, later this year or maybe next year for rental properties to reach a certain EPC level. And actually that's now been abolished. But there were definitely some landlords thinking, what are the costs I'm now paying a lot with my mortgage, the cost of my mortgage on this property. If I need to invest a lot of money in insulating it and bringing it up to the energy standards that are required, again, it's more of an investment in that property that they perhaps weren't bargaining for. So we were seeing, a few more landlords leaving the sector on that basis.
And I guess I understand that U-turn then if that was going to be passed on to renters who already, okay. Right. Is there anything area specific that our viewers should be aware of?
I suppose the strongest markets, if you were thinking about sort of where it's going to be outperforming, because we can talk a lot about averages, but prime central London is where we think the strength of the market is, and certainly thinking about those wealth corridors coming out of prime central London down sort of the southwest, down the A3 through Surrey. Those are the areas that they're very, that they see very wealthy buyers buying properties there. There's a lot more cash in these markets. They're not so constrained by, affordability and the reliance on mortgage debt. And it's also a bit more of a discretionary purchase. So, this is the market that has still continued to see the levels of activity in the super prime markets through these times of uncertainty.
When you say central London, do you literally mean on the tube map or?
So we have different definitions, but prime central London, I would say, is, think about sort of the royal parks, think about, Kensington and Chelsea, Westminster, up to Marylebone, Belgravia.
Okay, excellent. And what about internationally?
Yeah, so as I mentioned before, Dubai has had a real sort of strong bull run of it, 17% growth in 1 year, which is extraordinary. I would say that that's definitely not going to continue at that same rate.
Okay.
I think that there's likely to be, there's still likely to be strong growth of around 6% in that sort of market is what our world research forecasts are. And also Hong Kong may see a bit of a boost, obviously, from these tax changes that I mentioned earlier. So those are two markets that
keep an eye on.
And then London, where London sits on the global stage, I think prime central London, having seen sort of quite unexciting levels of growth in the past, and actually it's seen sort of successive small price falls over the last sort of 9 years since 2014, which was the previous peak. we're now down 19% in terms of nominal values. And if you think about how international prime central London is, a lot of buyers will be buying based, from other currencies. And if you convert that that total saving for those, if they were buying in US dollars, that saving would be 40%. So if we think about London on the global stage and where it sits relative to other cities, I would imagine it's looking quite positive.
Great. Oh, that's all so interesting. Thank you so much, Katy. And it'd be lovely if you come back again in the future to update us on all sorts of things, specifically how things are evolving in the housing market, because I think our viewers will have found that really interesting.